Right, let's also welcome in Sunil Subramaniam. Sunil, good to have you with us. Now, I know that you're an eternal optimist, Sunil, but how are things looking currently? As we were just listening into that conversation with Ramdeo, also saying this isn't a situation that's just going to completely disappear in 40 days. A, it's continuing, and B, the ramifications will likely be felt for a while. While SIPs were holding out for a long time, now we're starting to also see the impact there. So first, give me a context, Sunil, on how you think things stand currently.
So I think the important context change, I would say is that today it's the lockdown which is hurting more than the virus itself. I think if you see the virus itself, India is probably one of the best countries in the world in terms of how they have managed it from a medical perspective. But they have had to take a very harsh lockdown step, which has had an immediate action on the economy. So why I would say this is, if you see lots of other countries, they are taking a balanced view. And if you look at they're allowing parts of the economy to function, but also their death rate and this is much, much higher. Now, I think we've been very careful, which is more prudent, good for the health of the economy in the long run. But we have created our own short, sharp black swan event by this rigid lockdown. Medically, it's perfect, bang on, but obviously, economically, it's going to have a very severe impact. And I agree with Ramdev ji that this is not go away in 40 days because if you look at it, there is demand destruction. It's not just a postponement of demand, which would just bounce back. There would be demand destruction. There would be job losses. There'll be migrants who will rush back to their hometown to get them back to the metros where they are working, which is going to take time. So clearly, the lockdown created pain is going to be there for a fairly extended period of time. And I think that's what we need to now factor in terms of the fact. But I would say that's the lesser evil compared to the fact that if medically we had been lax, the economy may not have been so much affected, but it would be far more heart-rending for us as a nation. I think nation takes precedence over the economy and the market.
Okay, fair enough. So Sunil, in that environment, then, what would you say is the right strategy to approach things with? Are we looking at a situation where things will remain volatile? We've seen, a slight move higher in the last couple of sessions, naturally, in line with global cues as well. Is that temporary for now? What's your strategy at the moment?
See, I think that, I've said this before on the show, right? The markets are a lead indicator of the economy, right? So if you look at the sharp March correction, right? And Nikunj asked me this on a previous show, so Sunil, you say that. So clearly the markets had read the economic sharp correction. Now, over the last 1 month, markets are up about 20%. So what I think the markets are telling us is that, yes, we know there's going to be an impact and we have corrected. Now, further correction, right? Unless some other bad news comes forward, I think whatever is in the visibility, that is those sectors which are going to get deeply affected, I think the market knows that and it has already corrected that. One. Second is that I said there's a permanent impact of some of these. Now, the oil is clearly a long-term positive. All the reports that I read, all the analysts that we have spoken to, say that medium-term oil price around $30 is look like where it will stabilize. Forget about the short-term negative price, and all of those are very temporary phenomena. But over the medium term, we are looking at a $30. Now, let's discount that $30 by another 50%. Let's get it goes to $45, $50. From an Indian economy, which was factoring in $75 for oil, to 50 itself is a huge saving. So I think that's something that's very positive for medium-term Indian economy, and the markets will recognize that. The problem is that we see that the economies will only do a long, broad, U-shaped recovery. But that's not necessarily true of the market. Because the market discounts the future, the moment they say that the U is beginning to turn, the markets will have a sharp V-shaped recovery. So I retain my view that I know that the markets are going to do a V-shaped recovery. So it's important to stay invested. The problem is, I don't know when that V turnaround is going to happen. It could be 3 months, 6 months, 8 months, maybe max of a 12-month period. So in that perspective, from an investor's perspective, right, whatever you have already invested, stay invested. But there is a big difference between staying invested in stocks and in mutual funds. I'll tell you why. Because there's an important short-term reallocation of the portfolio, which is critical. Why? Because while mutual funds do buy stocks with a 3 to 5 year outlook, The fact that they have a benchmark of the indices to manage against means that they always have to keep their eye on the near-term bumps and the potholes as opposed to the long-term destination. Why I make this critical point, you'll see mutual fund portfolios shifting it so-called safety, that is the FMCG sector, the healthcare sector, in the short run. But don't expect that to last forever. The NBFCs, again, they'll be in the short term negative, but they could quickly switch track when they see the green lights in the economy at the end of the tunnel. But a stock picker or an individual stock market investor would not be able to just enter a stock, exit a stock. So I think the value of investing through mutual funds is more than, kind of reinforced at this point, number one. Number two is the SIP culture, right? The point is that all of this correction in the market, right? I think over the last month, if somebody sits down and does a portfolio at the end of 3 years, they'll find that March 2020 was their brilliant investment in terms of the SIP installment. So I think the SIP story gets reinforced. Looking at the portfolio today is obviously not the right thing. But if you're looking at it from a medium-term perspective, when you stagger it, what happens is that you're making sure that even if it recovers in 3 months or in 9 months, you have gradually bought units of that mutual fund, which is effectively of the stock market in a progressive fashion. So I would say that the strategy that I have been suggesting all this while continues. And in fact, for the more aggressive investor, I would say over the next 6 months, please top up and double your SIP installment. If you're already on an SIP, I would say please go. If you can double the installment for the next 6 months, that'd be great. Because what you're then doing is making rupee cost averaging become rupee cost double averaging. You're actually making that work in your favor. So if you're convinced about rupee cost averaging, then actually go and do what the SIP is doing even more now.
Okay, Sunil, great point. Like we were discussing last time that in any market in any cricket match, you need to sometimes go back foot and sometimes you need to go front foot. For a genuine long-term investor, time to go front foot. Having said that, Sunil, in the morning meeting, what we were discussing when we were preparing for the show with my team, that what is happening to SIPs. There is a view in the market that in the month of March, there has been a mass cancellation of SIPs. Is that true? What's been the update at Sundaram's end?
Two things here. Even in the market, I don't think it's been a mass cancellation. What has happened, new SIP registrations have dropped. Okay, one. Two is maturing SIPs. So I don't think this is, there were a lot of 3-year SIPs which matured in March, 1-year SIPs which matured in March. They haven't got renewed. And the reason for this, because we look at the rest of the portfolio, and I'll come to Sundaram in just a bit, this is not happening. So what is the reason for this? The reason is that the lockdown has made sure that the distributors, especially the bank relationship managers, are unable to go and reach out to new customers to convince them about SIPs and to talk to their existing customers saying, please sign a fresh form starting a new SIP. So it's more of a practicality of the lockdown rather than any panic situation. And at Sundaram, I can tell you that our month-on-month net new cash has actually increased to 20% and SIP flows are stable. So I don't see this as an industry-wide phenomenon. Definitely new SIP registrations will be on a slowdown and old SIPs maturing will not get renewed so fast purely because of the technicalities that not many people have switched completely digital. A new customer cannot go straight to on digital. There's a KYC process still physically to be completed. So I think these are the practicalities which are impacting the SIP flow situation. But on the mass, I don't see investors panicking at all. Not yet, at least. And like I said in the beginning of my speech, Nikunj, right now it's the lockdown which is hurting economically rather than the COVID. So the lockdown is obviously a very severe lockdown. So if physical movement is completely stopped, everything has to be done online through banks and net. It's not such an easy world to operate in.
Okay. My next question, Sunil, is about buying gold into the portfolio. Should one buy gold?
See, I would say that when you look at asset allocation, right, gold is an important asset to be there. Why I say this is, gold is your ultimate haven of safety. When there's a war, deep inflation, when the US dollar is under pressure, which is the reserve currency for the world, gold tends to do well. So it's more like a safety net. In India, the bank deposits in good quality banks has also been a safety net because it's fixed return from generally, something which has not failed. So this safety element of your portfolio should be there always. Now, it should have already been there. But if it's not there, this is not the time to add. And this is not the time to increase. Because what I'm saying is that every economist in the world, every analyst has been projecting a future and predicting the bad news, and the markets are already discounting that bad news. So gold is already enjoying the fruits of the bad news of the economies, the bad news of the stock markets, and the bad news on crude and everything else. So if you then look forward from today, Nikunj, the point is that bad news going to get worse? Is that going to get is the world going through even more of a deep thing? My sense is not, because though some countries delayed their actions in responding to COVID, today I think everybody is serious about it. And I think the economic impact, the way the markets are discounting, I would say is pretty much close to the bottom in terms of their bearishness of the future as an economy. So in that context, gold having already enjoyed the benefit, it's actually like you're buying equity market at the highest PE ratio, right? So I would say gold is in that kind of a situation, right? So I would say if you had gold, great, you've enjoyed the run, but not necessarily a good time to add gold today to the weightage that you already have.
A couple of days ago, I think on one of the global networks said the following, that it takes years for markets to reclaim their previous lows. This is what we saw in 2000, in 2008. And are we likely to see the same in 2000, post the 2020 sell-off? It may take 2-3 years for markets to reclaim their new previous highs.
I would say an overall market perspective that might be true, because the market is a conglomerate of sectors. So some of the sectors which were present when the market was its high obviously are going to collapse. They will not exist. Like oil commodities stocks, for example, right? Broadly, that's very simple. If oil was trading at $75 to $80 sometime back, it's going to go to an ultimate reset of 30. Clearly, those companies are going to be up deep, deep state creek. So, from a index perspective, that may be true, because those will then stop or fall out of the index. A new thing will have to come in, and the index come in. So people read market as indices, and that's why this thing comes through. But if you look at a mutual fund portfolio which has a flexibility of shifting, I would say mutual fund NAVs will not take that much time to reach their lifetime highs as long as the index may take to reach the lifetime high, because the fund managers has the ability to keep, like you said, buying when there is fear and panic, keep reshifting the portfolio based on what near term is going to not get affected, and all those smart kind of a decision making.
Do you worry about this overpositioning in financials? 35 to 40% of the total benchmark for most of the funds is about owning financials. That's where the underperformance has kicked in. With the exception of insurance, remaining financials are a leverage play, which means economy does well, they'll do well. Economy does not do well, they'll start tanking. Now, financials, they start underperforming, or banks and NBFCs, if they start underperforming, that may force a lot of people either to change their allocation or live with the pain.
So I agree that it's not just the economic downturn, Nikunj. What's affecting banks is that in this economic downturn, there's going to be a widespread NPA issue. See, normally in an economic downturn, there's a slowdown, so you expect a restructuring and all that to happen. But right now, because again with the lockdown, because there's so many businesses, cash-based businesses which are out of business, you're going to see a spike in the NPAs, and the markets are discounting that, and still they don't have a clue as to what's the level of NPAs that's going to come out because of this lockdown, right? So in the short term, what you say is right, that financials are a kind of less safe play. I would not hate to use the word risky play, less safe play. But for the very reason that you mentioned, Nikunj, that they are highly leveraged plays, is that discounting has happened, right? From that leverage play, when the phoenix rises from the ashes, when the economy recovers back to normal, these will show outsized gains precisely because they are leveraged play. So a deep short-term pain, but a massive long-term gain. Now it's your call whether you want to stay through that pain to enjoy the gain, or be very tactically so-called smart and sell off during this phase. And hey, I'll go back and pick it up when I see the gain happening. So that's, I think, the function of different portfolio managers' views, what funds they have, whether they have that. At the same time, I link to the previous question, Nikunj. You talked about lifetime highs. Now, one of the problems is again with the financials being such a large part of the index, right? To reach that can happen when the financials come back, because how much ever the correction happens in financial stocks, they're going to remain a part of the index. They're not going to go away. They're not going to completely disappear from the index. So index weightage of 35% may come down to 35% because of this correction over a period of time. But because they are such a significant part, coming back to their lifetime high will mean that these will have to come back. And that's where a portfolio manager's challenge is. Because you're measured against the benchmark, even if I have a very bearish view on the financials, the point is, if it's in the benchmark, then I look foolish if suddenly the benchmark rises and I'm not holding it. So I can be overweight, underweight the benchmark, but I can't go to zero. I can't completely exit something which is a significant part of the benchmark. So that's where you see in financials, though the news looks bad, you still see a significant amount of investment staying invested. It would have gone to underweight in most portfolios. People wouldn't be adding financials. On the contrary, they will probably do a flight to safety there. They'll get rid of the marginal financials with greater exposures to micro retail, and this is where the pain is going to be more, and go into the more safer, bigger names, so to speak. There will be zero, though they will not add incrementally in terms of their positions in financials.
Okay, Sunil, good to have you on the show. We'll let you go on that note. Thanks as always for taking the time out and joining in. Well, the one sector which has been